2019 exam. The first question asks us to prepare all the necessary journal entries to correctly record all the transactions relating to the additional information, points 1.3, 2.1, 2.2, 5, and 6 in the accounting records of Ginger only for the year ended 30 June 2018. Right, so as we read through the information, we'll see what journals are required. Usually the journals that they want are revenue journals. They quite like to ask the revenue journals. They also like to ask provisions and what's the other one? Dividends declared. Right, so there are a few journals that if you know them off by heart, or if you know what's going on there, you can quickly jot them down to know what's happening. Right, so what I would have done in preparation for this question is basically just written out, this is point A. What I'm required to do is journal entries, and then said for point 1.3, 2.1, 2.2, 5, and 6, so that as I get to those paragraphs, I know, okay, there needs to be a journal for this. Right. B asks me to prepare the statement of profit and loss and other comprehensive income for Ginger Limited for the year ended 30 June 2018, according to the classification of expenses by function method. Right, by function method means your expenses are in essence more grouped together than they would be if they were by, what's the other one? Nature. There you would have a depreciation expense, a salaries expense, all of those. Here they group it together in a few different ones called admin expenses, selling and distribution, and I think there are two other ones. You have your finance costs and so on. So there are 4 general categories of expenses. So I would suggest you know what those expenses are, and before you even start reading the question, you can go and start prepping for this one. So you'll say, this is Ginger Limited. We're looking at the statement of profit and loss and other comprehensive income for the year ended 30 June 2018. And all of you know what the statement of profit and loss looks like. You always start with your revenue, cost of sales, you've got your gross profit, other income, other expenses, distribution, admin, finance charges, and most of these you will get from the trial balance if they provide you with one, which they did in this case. All right, so you can use the question as reference. Just make sure you prep your answer so that when you get to those amounts, you can just slot them in. Yes. Yes, IFRS, I think IFRS does prefer function over nature. More likely to ask for function, yes. But if they do ask for nature, it's easy, you know, it's disgrouped, so. Then they say include only the lines above profit before tax. So your income tax expense comes later then. Then number C is to calculate the deferred tax balances in the statement of financial position of Ginger Limited for both the years 30 June 2017 and 30 June 2018 according to the statement of financial position approach, and indicate whether your answer is an asset or a liability. And they don't need to tell you that. Please always indicate whether it's an asset or liability. And also, just coming back quickly to the journals, if they do ask you for journal entries, do remember that you always have to indicate which account it is. Is it statement of financial position? Is it profit and loss? Is it statement of changes in equity? All right, so they want the deferred tax calculations from us. In terms of that, you all know what these calculations look like. You have your carrying amount, tax base, temporary difference, and deferred tax. And because this is a calculation they actually asked you for, I would not abbreviate. So I would write out carrying amount, tax base. So make sure you know when to abbreviate and when not to abbreviate. Next question is to calculate the current tax expense in the statement of profit and loss and other comprehensive income of Ginger Limited for the year ended 30 June 2018. The movement in temporary differences in the current tax calc should be calculated using the statement of financial position approach. So to complete question number D, you will need the answer from question number C. Right, and here it becomes really important for you to know your formats off by heart. You need to know exactly what this calculation looks like so that you can jot it down as you get to it. Calculate the current tax expense. Where do we start? We always start with profit, or our accounting profit, profit before tax, and that would be the answer you calculated in B. Remember, they asked you for the statement of profit and loss. Right, you'll have your permanent differences, you'll have your foreign income, capital gains, and that'll give you your taxable income. This one is obviously a condensed version. When you do get that, try and write the format as complete as possible so that you can see what is necessary to go in there and whatnot. Right. Then the tax rate recon, another thing that you need to know what it looks like. You need to know the format of that one. As you get that question, make sure you draft that on a separate page. And then lastly, they want you to disclose additional information in point 2 in the notes to the financial statements for the 30th of June. For that, you can just maybe start by writing, this is Ginger Limited, notes to the financial statements. You don't know what note is entailed in number 2 yet. So as we get to the information in number 2, we can disclose what's going on there. Right, are you guys comfortable with how to approach this from the very beginning? Okay, so let's start going through the question then. All right, so they tell us that Ginger Limited is a listed South African company that manufactures and distributes soft drinks. Ginger Limited's financial year end is the 30th of June 2000 and, well, I think in this case they asked us for 2018. Right, so 30 June 2018 is our financial year end, and you are responsible for the preparation of the annual financial statements of Ginger Limited for the year ended 30 June 2018. The following is an extract from the trial balance of Ginger for the year ended 30 June 2018. Right, we've got admin property, there's land and there's buildings, and they tell us there's additional information in point 1.1 relating to that. We've got motor vehicles, additional information in point 1.2. We've got inventory, again more additional information. There's tax payable, more additional information. And then you have your cost of sales, other expenses, there's sales, other income, depreciation, there's salaries, you have accumulated, So they've given you a lot of expense items, and you need to now go, remember they asked us for a statement of profit and loss. So as soon as we see these amounts, we are going to want to start grouping them where they need to go. Right, as soon as you see, okay, there's sales, let's jump to our statement of profit and loss. And obviously this is not going to be at the final amount, but you can have your calculation start with 4185711. Cross that out because we're done with that one. In terms of cost of sales, they started with an amount of 3,772,300, and we'll put that into our calculation firstly. Right, so that's the way I want you to approach the question. As you see something relevant, put it into the correct place. Okay. Then they've given us other expenses to the value of 424,000. Other expenses, you can have your calculation 424. We don't know if anything is going to be added or subtracted as we go through the information. Right, so we've got cost of sales, other expenses have been dealt with, sales, and other income. Then you'll see there's depreciation on admin buildings and motor vehicles. There is salaries for the sales reps and salaries for the admin personnel. Right, so in terms of salaries for the sales reps, that I would classify under selling and distribution expenses. Okay, so here you need to use some discretion as to where to classify those. Salaries for admin personnel, that I would classify under admin expenses. All right, so in terms of depreciation, we've got depreciation on the admin building and the motor vehicles. In terms of the admin building, that I would also classify under admin expenses, agreed? And then the motor vehicles, depending on what they use it for, just see where we put that. 100,000, 328. Did they put it under distribution expenses? Yeah, it depends on what they use the motor vehicles for. We'll get to that paragraph just now. So whatever you can classify, put that in there. If you're unsure about an amount at this stage, just maybe write it to the side and indicate, okay, it could either go to admin or to that. As you get more information, then slot it into the right place. Okay, you guys happy with that? All right, so other than what we've seen here, one thing that does stand out to us is foreign tax paid. There is some additional information in note number 4. What we do know, however, is if we had to pay foreign tax, that means we had to generate foreign income. And foreign income is not taxable in South Africa as well usually. So that foreign tax paid will be a permanent difference on our tax calculation, and it will also have to be noted on our tax rate recon. I'm going to skip that one, just noting that for now. We'll get to that if we discuss note 4. You guys happy with that? Cool. Right, then let's look at the admin buildings or property, plant, and equipment. Right, so in terms of the administration property was acquired on the 1st of July 2015 at a cost of 1.6 million. The land was 600,000 and the building cost $1 million. On this date, the building was available for use as intended by management, and depreciation on the admin building was written off over a period of an estimated useful life of 10 years, according to the straight line method. The residual value of 0 was allocated to the admin building, and SARS does not allow a tax allowance on the admin building. No other admin buildings were acquired or sold during the year. Right, before we delve into that calculation, what I first want to do is just draw a timeline so we can orientate ourselves. Our year end, we said, was the 30th of June. I'm going to do this on a separate page. Right, our year end is 30 June 2018. That makes the first day of our financial year the 1st of July 2017, and they told me that this building was purchased on the 1st of July 15. So on the 1st of July 2015 we purchased this land and building. The land, let's use a different color, was 600,000. The building cost $1 million. And they told me that I write off this building at a depreciation rate over 10 years, according to the straight line method. So do you agree with me that every year we would have depreciated 100,000? $1 million divided by 10 gives you 100,000. Everybody happy with that? Cool. So do you agree that the opening balance for this building, carrying amount wise, would have been 800,000 on the 1st of July 2017? Is everybody comfortable with that? Right. So what we're going to need in terms of doing our deferred tax calculation, which they did ask us for, would be our carrying amount and our tax base at the 1st of July 2017, because that's the closing balance for the previous year, would be the opening balance for my current year. And then if I want to do the current year calculation, I will also need the carrying amount and the tax base for 2018. Is everybody happy with that? Right, so we know that the SARS does not allow a tax allowance on the admin building, and no admin buildings were sold during the year. Right, so let's see. Everybody agrees that our carrying amount was 800,000 beginning of the year, and that would make it 700,000 at the beginning of, at the end of our financial year, and that is with relation to the building. Let's just write that 100 in here. In terms of the land, there's no depreciation on land, so that'll be 600,000. Right. If SARS does not allow a tax deduction on this, do you agree that initially there would be a difference when we look at that tax calculation? And that would then lead to this being an exempt temporary difference. So just going to where I did that calculation, you'll see, firstly, land had a carrying amount of 600,000. That land would not, there won't be a deduction from SARS's side. What we will receive, however, is that 600,000 as a deduction when we one day sell this property. So if there's a growth in the value of the property, when it is sold, we will make a capital gain on that, and we will be taxed at capital gains tax rates. But initially, we don't get any deductions for either the land or the building, and both of those will be exempt as per IAS 12, paragraph 15. I don't think you need to go into detail as to saying paragraph 12 or IAS 12:15, but if you do want to write that there, I think it is a good idea. You can just write exempt under your temporary differences. Right, so we know we calculated that tax base, the carrying amount, to be 800,000 in 2017, and then $700,000 we said in 2018. Okay, let's just finish the information. Maybe there's something else. Okay, so this is, just scratch that, please. That 300,000 should obviously be 700,000. You guys happy with that? Okay, so there is the first thing you need to fix. That's for 2017 and 2018. Both those differences are exempt. However, the issue we have now is we have a depreciation expense, and that depreciation expense is going through my statement of profit and loss. However, SARS does not allow that as a deduction for tax purposes. Does everybody agree with that? So that will then end up being a permanent difference to us, and that we need to note in both our tax calculation as well as our tax rate recon. Right, so as we get that information, we know that the depreciation for the year is equal to 100,000. More than that, they actually gave us that depreciation on the admin building, so you didn't even need to go calculate that. Right, so immediately going to our tax calculation, depreciation on admin building of 100,000 needs to be added back because we will be taxed on that. Happy. Then in terms of my tax rate recon, you'll see under the permanent differences, again, I have that admin building. This time it would be the 100,000 times my tax rate, which I haven't read as yet. If I can quickly jump to that part, they do tell me that SARS tax rate remained unchanged for the last few years at 28% and capital gains at 80%. So I can say that's 100,000 times 28%. Everybody happy there? Great. Right, so that is in terms of the admin building and the land. We can scratch that as having dealt with that. Right, in terms of point number 1.2. On the 1st of July 2015, Ginger purchased 8 motor vehicles at a cost of 255,000 each. Right, so this was purchased on the same date that we bought that land and buildings. We bought 8 motor vehicles, and each of them cost 255,000. Can someone just confirm that that adds up to 2.4 million? Yeah. How much? 2.4. Okay. 204. 204. Oh. Right. So that's what we purchased them for on the 1st of July 2015, to be used by the sales representatives. Right, in the case that they're used by the sales representatives, I probably would have classified that then as the depreciation on those motor vehicles under selling and distribution expenses. Let's see if I actually did do that. Selling and distribution, yes, that's why I put them over there. You guys happy? Cool. On this date, the motor vehicles were available for use as intended by management, and they were also brought into use. On the 1st of July 2017, the directors of Ginger sold 2 of the motor vehicles used by the sales representatives for cash. Right, so back to our timeline. This is on the first day of my new financial year. Let's continue in purple. On this day, we sold 2 of these vehicles. The cost of those vehicles was 255,000 still. So that means we are only left with 6 vehicles that we are going to depreciate for the year going forward. The directors of Ginger sold 2 of the, oh, I've read that. The details of the sales transaction of the 2 motor vehicles sold were as follows. Right, so the sales price was 540. The cost was 510, and that is obviously 2 times your 255,000, which was your cost. Right, if my selling price exceeds my cost, what do I have? Capital gain. Right, so in this instance, can everybody see that there's a 30,000 Rand capital gain? Right, so firstly, I'm quickly going to deal with that capital gain. We need to account for that capital gain in my tax calculation as well as my tax rate recon. Right. So, in my tax calculation, you'll see that under my permanent differences, I deducted that capital gain, and that calculation would be 540,000 minus my 510,000. So what I'm saying here is that included in my accounting profit is a profit of, or a capital profit of 30,000. SARS is not going to tax me on that capital profit at normal tax rates, but rather at capital gains tax rates. Yes? Sorry, say that again. Yes, terminology, I'm not too specific on. I think what I would suggest in terms of that is look at what the Tatleto 103 refers to. Maybe refer to that. Okay. For me, honestly, if I were marking this, I would give you a mark if it was capital gain, capital profit, whatever you called it, as long as you got the principle right. But in truth, I'm not the one marking, so yes. We'll get to that in a second. They did ask me for journal entries for 1.2, did they not? They asked for 1.3. Okay, so they didn't ask me for those journal entries. I'm going to do the journal entries with you anyway, so you'll see just now. I just quickly want to deal with the capital portion of this. Right, so in terms of what we're doing here is we are excluding the capital gain, but then we are including it again at capital gains rate. So what we will be taxed on is not the full 30,000, we'll only be taxed on 80% of that. And that's why I include the 24,000. So you'll see in a lot of the UNITA solutions, what they do is they will just show the net 20% that you won't be taxed on. I suggest keeping the 2 separate, showing, taking out and putting it back in. Okay. I don't think I intended it for it to go under permanent differences. I think I would have like a little split there. But the first item after, I would, yeah. And then in terms of my capital gains in my tax rate recon, you have your normal rates, again excluding it at normal rates and including it at your capital gains tax rates. So the normal rate would be 30 times 28%. Your capital gains rate would be 30 times 28 times 80%. Right, and then just finishing this quickly, they say that the sale of the two motor vehicles have not yet been recorded in the accounting records of Ginger for the year ended 30 June 2018. There were no other motor vehicles purchased or sold during the year. Right, so they're telling me they have not yet accounted for the sale of these motor vehicles, so I need to go and account for that. That means that looking at other income over here, there's not a profit included in there yet. I have to go and manually include it. Right, so the way we would do that is I would require a journal entry in terms of this transaction. Okay, and for that, I'm just going to give you 2 minutes to quickly do that journal entry. I just want to see if you guys can, well, obviously I know. Right, let's quickly have a look at what that journal entry would look like. Firstly, noting that the sales price was 540, and they did tell me that these were sold for cash. That means I'm going to be receiving cash into my bank account. So the first thing I need to do is increase that bank account, and that would be a debit to my bank of 540,000. That's what I actually received. Then I need to de-recognize my asset because I'm getting rid of that asset, but that asset obviously comes with some accumulated depreciation. So I need to get rid of both the cost and the accumulated depreciation of this vehicle. Right, so firstly, there would be a credit to the cost, or let's call the account motor vehicles at cost. That is in my statement of financial position, and the cost of these vehicles also was given to you as 510. Right, then there's going to be a debit to my motor vehicles accumulated depreciation account. Again, that's in my statement of financial position account, and you'll see what they gave you is they gave you the carrying amount of these motor vehicles. Right, so the difference between my cost and my carrying amount, do you agree, would have to be my accumulated depreciation? Okay, so in this sense, my accumulated depreciation would then be 255,000. Okay, going back to my timeline just real quickly. We bought these motor vehicles in 2015. We sold them on the first day of 2017. Can you see that 2 years have actually passed since purchasing them? If I know that in these 2 years, I've basically written off 50%, okay, they haven't told me straight line or, what's the other one? Diminishing balance method yet. They haven't told me the depreciation rate at all yet, as far as I've read, but I can safely assume that might be 25% a year. Okay, so your brain's already thinking, how are these things depreciated? If 50% over 2 years, most probably 25% a year. Right, so that's my accumulated depreciation, and then that means I made a profit of the difference, which would be, is it 285? 285. That 285,000 is the profit that I would recognize in my books for IFRS purposes. But that is not the profit for SARS purposes. Remember, for IFRS we have depreciation, whereas for SARS we have wear and tear allowance. In terms of SARS, the profit would be, right, if for IFRS your profit is equal to your selling price minus your carrying amount, let's just say the IFRS. For SARS, your profit would be selling price minus tax base, right? However, for SARS purposes, had this been a capital profit, that needs to be split into what is capital of nature and what is just normal. Right, so looking at this 285,000, we know that the capital portion is 30,000, and then the 255,000, if you look at it from SARS's point of view, would be a recoupment. Sorry, I'm looking at the IFRS values now, but just forget what I just said. That's the truth looking at it from an IFRS point of view. From a SARS point of view, whatever amount you get here would be split between the capital portion and the recoupment portion. The capital portion we know being 30,000, the balance would be the recoupment. Right, so what SARS is saying basically is whatever deductions we gave you in the past on these motor vehicles, because you've now sold them, we want that back. So you'll be taxed on that. You guys got that? So what's happening here is I included a credit profit of 285,000 for IFRS purposes. They told me that that has not yet been accounted for, so I need to go and add that to my profit before tax in the line item called other income, because my normal business is not the buying and selling of motor vehicles. That's why it doesn't go to revenue. Right, so that 285,000, in terms of your calculation, you will have added it to your other income plus 285,000. Okay, does that answer your question of why it's included? Okay. All right, so is everybody comfortable then with 1.2? Yes. Yes. The balancing figure is my profit. It should be balancing. All right, then in terms of question 1.3, they continue on this whole motor vehicles thing. Just quickly, what I want to point out is when we were looking at our trial balance, they did actually give us the depreciation for the motor vehicles. So we know that though the sales transaction has not been accounted for, depreciation has in fact been accounted for. Right. So, and for 1.3, they actually asked me for the journal entry. So for this one, journal entry needs to be done. Right, motor vehicles are depreciated according to the straight line method at 25% per annum, which is what we assumed anyway. However, the directors re-estimated that the useful life of the motor vehicles and determined that the useful life of a motor vehicle on acquisition date is actually 5 years. Right, so just jumping back to that timeline I'm drawing. When I bought these motor vehicles, do you agree that I estimated the useful life to be 4 years? 25% times 4 would give me the 100. However, now I'm saying, actually on that date, it shouldn't be 4 years. It should be 5 years. Issue is, this is a change in estimate. Changes in estimate are not dealt with retrospectively, only prospectively. So what I'm telling you is, depreciation I wrote off for this year, that's fine. Depreciation for that year, that's fine. What needs to change is my current year depreciation. That's the only depreciation that will change. Right, and they've already given me that depreciation figure. They've written off depreciation for this year of 382,500. That is the old depreciation figure. And the way they would have calculated that is they would have said, okay, we know we had 8 motor vehicles, we sold 2. Total cost of the 6 motor vehicles, can someone please help me with that calculation? I think it's 1.8. So 6 times 255. 1530. Right, so that divided by, or times rather, say times 25% would be 382,500. So you can see that the depreciation that they already wrote off was based on the old depreciation. Right, they have now changed that depreciation and they say these vehicles have a useful life of 5 years. Do you agree that having had 2 years past, that now my remaining useful life would be 3 years? Okay, so the remaining carrying amount on the 1st of July 2017 instead of being depreciated over the remaining 2 years, needs to now be depreciated over the remaining 3 years. Is everybody comfortable with that? Right. So for that, I need to one thing, I guess, and that is my carrying amount on the 1st of July 2017, and in fact I would have needed that for my deferred tax calculation as well. Right, so I've already got the cost of 6 of those vehicles, then taking off the accumulated depreciation, which I know would have been 50% at that stage. So can someone help me with that? 50% is that 765. Am I right? So my carrying amount, 765,000. That divided by 3 years would be my new depreciation. How much is that? How much? 255. Okay, that's interesting. All right, so 255, that is my new depreciation. All right, you guys will see I did do a calculation. If you want to see it in a little bit more detail, just go here and you'll see there's a comparison between the old and the new. What I've done there basically is I've taken the cost minus the accumulated depreciation minus the carrying amount of the 2 vehicles sold, and that would have gotten you to the same 765,000. That's the carrying amount at the beginning of the year. Is everybody quite comfortable with that? Right, and then if you divide that by 2 years, you get 382,500. If you divide it by 3 years, you get 255. Everybody 100% happy with that? Cool. So what needs to now happen is, let's just finish reading this paragraph before we jump ahead. Due to the implementation of a new maintenance plan, the effect of this change has not yet been recorded in the company's accounting records for the year ended 30 June 2018. The residual value of the motor vehicles remained unchanged at null throughout the period, and then they talk about the tax allowance. We'll get to that now. First thing I want to do is the journal entry. Right, so do you agree that depreciation that was accounted for by the company amounted to 382,500, but it should have only been 255? So the difference between that is the journal that I need to pass to bring it down from 382 to the 255, and that is an amount which 127,500. Say 127,500. That's the difference. My depreciation, what I would have done to account for this leg of the depreciation is debit depreciation, credit accumulated depreciation. Agreed? Yes. How would you want to do 2 separates? Oh, okay, yeah. So you reverse this full amount and then account for that. Let's just see. They asked you to prepare all the necessary journal entries to correctly account. I don't think they will penalize you. I think it would make sense if you wanted to reverse it full and then account for the right one. I think you have both options. I think if they asked you for the correcting journal entries, then sometimes they're specific in wanting you to account for the difference. Yeah. The net effect will be the same, yeah. So if you want to maybe just be safe, maybe do the 2 separates as a calculation and then just show the net effect. So then basically what we're going to do is we want to reverse some of that depreciation. To reduce our depreciation expense, we need to credit that. So credit depreciation, debit accumulated depreciation. Is everybody happy with that? Okay, so that's the first thing we need to do in terms of this. As far as I know, they didn't ask us for the disclosure, only for note number 2. What the disclosure would look like is you would want your profit before tax note. You would want to show your last year's depreciation and your current year's depreciation, so those comparative figures, and then give a note of how the depreciation has changed. Okay, I think the next question might have a example of that. So that's the first step. I just need to gather my thoughts here. The second thing we need to account for, or that we need to calculate here, is the carrying amount for 17 and 18, as well as the tax base for 17 and 18. Right, because we're going to need to do that deferred tax calculation. Right, so firstly, in terms of the closing balance for 2017, what we're looking at now is the last day of my previous financial year. Remember that those 2 motor vehicles that were sold were only sold on the first day of my current financial year. Right, so that carrying amount would need to be made up of the full 8 motor vehicles minus the full 50% depreciation. Right, so if I go back to my calculation I did over here, you'll see that the carrying amount on the 30th of June amounted to 1020. So 1,020,000. You guys happy with that? Right, and then after the depreciation was done for the current financial year, which only amounted to 255, my carrying amount at year end, 2018. Sorry, that's the sale. And then I've got my depreciation for the current year amounting to 255,000. Carrying amount at year end is 510. Happy with that? So in terms of my deferred tax calculation, looking at my 2 carrying amounts, I go from 2017 being 1020. I deduct the sale of 255,000. I deduct the depreciation of 255,000 and arrive at my carrying amount for 2018 for 510. Okay. Then they talk about the tax allowance, and they tell me that the tax allowance on motor vehicles in terms of section 11E is 4 years, which used to be the same as my carrying amount or my depreciation period. According to the straight line method, it's apportioned for part of the year, but I had these motor vehicles for a full year for every year I had them. The tax base of the remaining motor vehicles on the 30th of June 2018 amounted to 382,500. Right, so 2018 they've given to me. 2017 I know will be exactly the same as my carrying amount because the depreciation period is the same. You guys happy with that? Right, and then you calculate your temporary difference. There's no one for 2017. For 2018, my temporary difference is 127,500, which is the journal entry I passed, ironically, and then at 28%, you'll get your deferred tax liability. It's a liability because my future profit exceeds my future tax deductions. So in future, I'm going to sit with a bigger profit, then I'll have tax deductions to utilize against that profit. Make sense? Right. That is all relating to point 1.3. Everything that we've done has been filled into the relevant answer. You guys happy? Right. Then point 1.4. Ginger accounts for property, plant, and equipment at the cost model. Great. Then inventory in terms of point 2, and this they have actually asked me to disclose. They say that on the 30th of June 2018, the directors of Ginger Limited decided to change the accounting policy in respect to the valuation of inventory from weighted average to the first in, first out method, as it will improve the matching of income and expenses. That's important because in your disclosure, that's what you need to tell them in your little description. The value of inventory on the respective dates before taking into account note 2.2 is as follows. Right, so we're moving from the weighted average to the first in, first out. They've given you subcategories, but all of them add up to the final inventory figure. So you can actually just ignore whatever is going on at the bottom and just look at those figures over there. Right, so you'll see in 2018, my weighted average was 700. It increased to 810. So do you agree that there was an increase in inventory of 110? Similarly, in 2017, went from 640 to 658. Again, an increase in inventory. 16 was 457 to 487. Again, an increase in inventory. Right, then SARS says that they will not reopen previous year's tax assessments. If they say they will not reopen, what does that mean? What do we have for previous years? Deferred tax. And they will accept the new inventory valuation method. That means what do we have for current year? Current tax, not deferred tax anymore. The inventory valuation method for tax purposes for the current year, this change has not yet been recorded. And if I'm not mistaken, they asked you for journal entries as well. Yes, they did. For the year ended, and they've only asked us for the journal entries for year ended June 2018. So we're going to do the journal entries for 16, 17, and 18, but what they want to see as a solution is only 18. Okay. Right. Then, before we carry on, just quickly want to read through point 2.2. They tell me that the finished goods at the Polokwane factory was inadvertently excluded during the physical stock count, and it is not included in inventory in the above trial balance on the 30th of June 2018. So what they're saying is that these balances do not include the goods from the Polokwane factory. Agreed? So that Polokwane factory still needs to be included there. Right, and that had a value of 25 and 37, which gives us a difference of 12. Right, so that basically just needs to be added to those values over there. When I did the physical inventory count, I didn't count those and I left that out. All that needs to be done is that it has to be included, so that takes my difference from 110,000 to 122 instead. Okay, you can do that in one. You can account for the difference first if you'd like to. One thing that I do want to point out is that this issue came in 2018. 2018 is the year that I am actually doing these financial statements, so it's not like the mistake came in last year. If that were the case, that would be a prior period error. Because it happened in this year, I can still fix it before actually telling people I made a mistake. Right, so the only thing that needs to be done is this is not 110, it's 122. Everybody happy with that? Right, so let's start with our journal entries for 2016. First thing that we need to do is, you can see that I want to increase in inventory. Everybody agree with that? Right, how do I increase inventory? Debit. So I will have a debit to my inventory. Where's that calculation? Debit inventory with 30,000. Credit, because it's in a prior financial year, retained earnings increases by 30,000. That has a deferred tax effect. Deferred tax, because they said they won't reopen previous years, of 28%. We debit, not income tax expense. Please change that to read retained earnings. And statement of changes in equity. And we credit our deferred tax with 8,400. First thing that needs to be done in 2017, because we said inventory is a rolling balance, is last year's journal needs to be reversed. Right, because that inventory would have been sold during that year. Is everybody with me? Okay. So, firstly, 2017, this journal, I want to use a different color, is reversed by crediting inventory with 30,000 and debiting, this time, cost of sales, because we do have comparative figures for 2017. And then with that goes the reversal of my deferred tax. Debit deferred tax 8,400, credit income tax expense 8,400. Right, so that's just dealing with the inventory that has now been sold. At year end, what has happened is, again, we have a difference between our weighted average and our first in, first out. And we need to account for that increase. So the way to do that is, again, increase in inventory. In other words, a debit to inventory of 18,000, credit to cost of sales of 18,000. And that has a deferred tax effect of 28%. Why deferred? Because they won't reopen previous year's tax assessment. 5040. Yes. Yes. So I'm reversing this entry over here. I'm reversing. So there's a debit to deferred tax. So, sorry, here's a credit to deferred tax. Now I'm debiting that deferred tax. No. I'm taking it from retained earnings to income tax expense. So same, you'll see where I had retained earnings there, I'll have cost of sales reversed over there. So basically what I'm doing is I'm taking profit from last year and putting it into this year. Okay, no, don't stress. Then one thing I do want to quickly do before we move on is, here I am accounting for a deferred tax. So I'm going to put that into my deferred tax calculation for 2017. In terms of my carrying amount for inventory, that would be my new carrying amount, what I have changed it to. So inventory has a carrying amount of 658. However, what did I tell SARS last year was this inventory balance? Last year I would have told them 640. They won't reopen that, so that's my tax base. Leaves me with a temporary difference of 18,000, and that is again a liability because my profit, future profit, is larger than my future tax deductions. Okay, everybody happy there? Right, and then I get to the 2018 journal entries. Same story. First thing that needs to happen is a reversal of prior year increases. So looking at that, I credit inventory with the 18,000 and debit cost of sales with the 18,000. That's just a reversal of 2017. Similarly, I'm going to reverse the deferred tax for 2017, debiting deferred tax by 5040 and crediting my income tax expense 5040. So the effect of that is then 0 in essence. Everybody happy there? Right, and then looking at my current year, I need to increase my inventory again, this time by 110,000 plus 12,000, so 122. Debit inventory 122,000, credit cost of sales 122. That has a deferred tax effect. Sorry, I'm lying. It doesn't have a deferred tax effect. It has a effect on my current tax because SARS will accept this inventory valuation method going forward. Okay, so current tax effect of 28%. So here where it says deferred tax, change that please to current tax liability. Right, and that would be of 28% of the amount stipulated over there. Is everybody comfortable with the journal entries? Any questions about them? Right. So that was point 1. Do you agree, before I move on to the disclosure, that cost of sales is a P&L item? Do you agree that I've affected that cost of sales? What does cost of sales affect? Or where would I go and account for this? Okay, that's a stupid question. What I mean is, they asked me for the profit and loss statement. In there is cost of sales, so I need to account for the effect of that. Right, so there's a minus to cost of sales of 122,000. credit cost of sales will reduce that expense. A debit to cost of sales will increase it. So minus 122,000 plus 18,000. You guys happy? Okay. And then the last thing we needed to do with that is disclose it. So you guys comfortable with reading a piece of information and then finishing everything that needs to be finished in terms of that piece? Right, so let's quickly look at that disclosure. In terms of 2016, I always start at the back. The journal entries that I had for 2016 were a debit to inventory, a credit to retained earnings, a debit to retained earnings, and a credit to deferred tax. Did I affect my profit and loss statement at all? Okay, the statement, physical statement of profit and loss for the 2016 year. You don't see a P&L reference anywhere there. Right, so that means P&L section over here, not affected. However, what I did affect is my inventory balance. My inventory balance increased by 30,000 and my deferred tax liability increased by 8,400. So looking at my disclosure, there was a increase in inventory of 30,000 and an increase in deferred tax liability of 8,400. Everybody happy there? In terms of 2017, my journal entries, I did indeed have P&L items in there. Do you agree? So I have affected cost of sales. Cost of sales is not a running total as inventory is that gets closed off to retained earnings every year. That means the net effect on cost of sales this year was a credit of 18 and a debit of 30. Do you agree that's a net debit of 12,000? What is a debit to cost of sales? Increase or decrease? Increase. And an increase in cost of sales means a decrease in profit. Agreed? Right, so looking at my note, you'll see that I have a increase in cost of sales. Can you see what I did here? I said decrease for 2018, increase in brackets then. So they know that the first one is a decrease, second one is an increase. Right, and the increase I put in brackets because the increase, it will have a negative effect on my profit. So I always look at it from the point of view of how is it affecting my profit. If you wanted to put the increase as a positive because it increases your cost of sales, you figure that out for yourself. You can do it whatever way you want. This way works for me. Right, so negative 12,000, and the effect on my income tax expense over there was a debit of 5040 and a credit of 8,400. Agreed, a net credit of the difference there. Credit to income tax expense decreases my expense, increases my profit. Right, so that's positive with a difference of 3360, and the net effect on my profit is a decrease of 8,640. In terms of my inventory, rolling balance over there, this inventory will cancel out that one. So the increase in my current year only relates to the 18,000. Increase in inventory is 18,000. Increase in deferred tax liability, 5040 as per the journals. Happy with that? Right, and then in 2018, looking at firstly my cost of sales, credit of 122,000, debit of 18,000. Agreed, a net credit of 104,000. Happy with that? And a credit to cost of sales is a decrease in my expenses and an increase in profit. So there you'll see I've got the decrease in cost of sales, but it's positive because it increases profit. Same thing with my income tax expense, one too far. I had a debit of 34,160, a credit of 5040. That means I've got a net debit, an expense, increases that expense, and decreases my profit. Net increase in profit, 74,800. We said that our inventory increased by 122, and please move this one line up. It shouldn't be under deferred tax, it should be under current tax liability. So your deferred tax there would be 0. Current tax would have increased by 34,000. Right, and if you want to do a test in a test or exam, 21,000 increase minus 8,640 should give you a net increase in equity over there. Similarly, 12,960 increase plus another increase of 74,888 or 80 would give you that. So that works in a zigzag type of form. If that works out, you know your answer is correct. And then the blah, blah, blah that you need to tell them over here is that the directors decided to change from weighted average to first in, first out to improve matching. Right, so that's another 2 marks you can get from that. Okay, everybody happy with this disclosure of inventory? Right, should go faster now. That has all been disclosed. We've finished inventory. Then we see there's a tax payable. No provision has been made for the current tax for the year ended 30 June 2018. The SARS Revenue Service accepts the accounting treatment of all the above transactions in all respects, except if they stated it as the contrary. Have I dealt with the deferred tax on the previous one? I did, right? Yes. Okay. Details of tax payable in the account in the general ledger are as follows. I'm just going to draw us a T account here so we can put that into perspective. So this is my SARS liability account, and I would have owed them something for 2017. So it would have been a liability. Then I would have made a provision. Okay, that would have been my provision for tax for 2017. Right, would have been 230,200. That's what I think they will charge me. Then I made a payment for the 2017 amount, and this included interest of 12,000. So in other words, I paid them late or something like that happened, and I had to pay them more than I owed them. So basically what I'm saying is, included in here is 12,000 Rand worth of interest. That means how much did I pay towards that liability? Do you agree? 230,200. What does that tell me? That tells me that what I provided for agrees with what SARS says. In other words, no over or under provision for that year. What they have gone and done, and this says, the question says that these are the details of the tax payable account. So they would have put in a debit on this side of 242,200. Right? And then we would have had a debit balance here of 12,000. But that debit balance of 12,000 doesn't belong there. Do you agree? Where's that 12,000 supposed to go? Sorry, can't hear. But the expense account basically for finance charges. Is that what you said? There we go. Now it clicks. Right. So this needs to be, this 12,000 needs to be taken out of that SARS account and put into finance costs. So what I'm going to have to do is I'm going to have a credit to the SARS account and a debit to my finance charges. Right, so if you go to your profit before tax calculation, you'll see that finance charges over there, we've deducted 12,000. Right, then that 12,000, is SARS going to allow that as a deduction when it comes to tax payable? No, but we've deducted it from our profit, so that's going to be a permanent difference. Okay, this one I missed, so please just put that in there. In terms of my permanent difference in point B, there will be interest of 12,000, and I'm going to be adding that back. So there's the first place it needs to go. Interest of 12,000. And then in terms of my tax rate recon, same story. I've got interest of 12,000 this time, times my tax rate, 28%. 3 what? 3360. 3360. Right. Happy with that. So those are the 2 places, 3 places that needs to go. Right, so I'm done with that interest. Then I have a first provisional and a second provisional payment. Just to refresh my mind, calculate the deferred tax, calculate the current tax expense, tax rate recon. I didn't need these provisional tax payments. They asked me to calculate the current tax expense, not the current tax due. Had they asked me for current tax due, I would have taken off those 2 balances. Okay. Right, then other income. Included in other income is foreign income amounting to 88,000 received from the United Kingdom, which is not taxable in the Republic of South Africa in terms of a double tax agreement. Ginger paid foreign taxes of 15% on this foreign income, and you'll see that they've calculated that 15% for you in the trial balance, where they said foreign tax paid 13,200. Right, so I need to account for that in my tax calculation as well as my tax rate recon. So you'll see the foreign income needs to be excluded because I'm not going to be taxed on that. In my tax rate recon, I need to exclude it at normal South African rates, so minus the 24,640, and then add what I actually paid, which is 13,200. Guys happy? Cool. That deals with point number 4. Point number 5 is a consignment sales agreement. It says on the 5th of May 2018, and they wanted journal entries for both 5 and 6. Ginger sold bottled water in terms of a consignment arrangement with Springs Limited for 90,000 to a customer on the 31st of May 2018. Ginger received 15% commission in cash for the consignment sales. The transaction has not yet been accounted for. Right, what is the first principle that we look at if we look at revenue? Revenue is the amount that we are entitled to receive. So looking at this, what are we entitled to receive on this consignment sale? 900,000? No? 15% of that 900. That's what we're entitled to. So that's the only revenue we can recognize. Debit, have they paid us for this? I don't know. They didn't say, did they? Commission in cash. Received commission in cash, great. So debit bank, credit, revenue, 900,000 times 15%. That's 900,000, right? Not 90. Is it 90? Okay, all right. And that's the 13,500. Agree that that affects my other income? Okay, that is not, it's not revenue because it's not my main sales is to do the consignment thing. So it goes to other income. In terms of my profit before tax, I need to add that to other income plus the 13,500. Right, and then the next one was on the 1st of June 2018, Ginger concluded a 3-year contract. Okay, let's go to the timeline. We're going to need it. 1st of June 2018, that was the 1 month before the year end. We concluded a 3-year agreement with G&T to bottle all G&T Limited's tonic water at the premises of Ginger Limited. The contract is effected on the 1st of June 2018 at an annual fee of 900,000 with an escalation of 5% per annum. The fees are annually payable in advance. So if then they told me that on the 1st of June, G&T paid the fees for the first year as per the agreement, and the bottling fees received from G&T has not yet been recorded in the accounting records for the year ended 30 June 2018. Right, so on this day, I actually received 900,000 into my bank account. Am I entitled to revenue of the full 900,000? No. Do I still owe the client something? 11 months worth of bottling, right? So the only revenue that I've earned is the period for 1 month. The rest is a revenue received in advance or a contract liability. Right, in terms of that then, the journal entry would be to debit my bank account because I received all of this money. Debit bank, 900,000. Credit revenue with only 1 over 12 months. And credit contract liability with 11 over 12. Everybody happy with that? Right, in terms of my revenue, I've got 75,000 that needs to be added to revenue. Everybody happy with that? Then the last thing is revenue received in advance. When does SARS tax me on money received? When I receive it. So I haven't included everything in my profit before tax, but I will be taxed on everything. So I've got a temporary difference. Deferred tax applies. In the 2018 year, I've got a contract liability or income received in advance of 825,000. That's 11 over 12. Of that, 900,000. The tax base for revenue received in advance is carrying amount minus amounts not taxable in the future. Carrying amount is 825. How much is taxable in the future? Nothing, because I've already been taxed on it. So amounts that are not taxable in future is the full 825, agreed, and that's where I get to my tax base of 0. That leads me to temporary difference, deductible temporary difference of 825, which is an asset to me. Everybody happy with that? Right. And that then concludes the information that they've given me. I have that. And then they give us the sentence in almost every paper. Company provides for deferred tax on the financial position approach. No temporary or exempt, blah, blah, blah. There is a certainty beyond reasonable doubt that the company will have sufficient taxable profit against which any deductible temporary differences can be utilized. All that's saying to you is if you have a deferred tax asset in any given year, you can recognize it because you expect to have profits in the future. You guys happy with that? All right. So that basically concludes all the information. In terms of A, I've done all my journal entries. We're happy with that we're done with A. In terms of B, I've shown you where all these amounts come from. All you need to go do is add them up and get to your profit before tax. Right, you'll see if maybe this was classified in the wrong place or you put something in the wrong place, you'll still probably get to the right amount. The classification would just be different. So make sure to indicate exactly, firstly, where your amounts come from, if it was a calculation or something you added, and secondly, if you do your calculation, show them from the trial balance what you've grouped together. Okay. Then in terms of 17, we've got our deferred tax liability. There was only the one amount. We had a liability in 2017 of 5,040. 2018, all we need to do is add it up, and we get an asset of 195,300. Then we need to calculate the movement in temporary differences so that we can put that into my tax calculation. Right, so my opening balance amounted to a liability of 5,040. My closing balance was an asset of 195,300. There was no change in tax rate, so everything to get from a liability, remember we had to move out of the liability position to a 0 and then create that asset of 195. So the movement is 200,340. Everybody happy with that? But that is at 28%. Agreed? So to get that at 100%, I need to say 200,340 times 100 over 28, or divided by 28%. It's going to give you the same answer. And that is what I have to put into my tax calculation. 715,500. I went from a liability to an asset, so I moved in a general asset direction. That means that was a deductible temporary difference. But when is that temporary difference deductible? This year or in future years? In future years, agreed? So in the current year, that would be taxable. And that's why I added here. Right, so added. We've discussed this profit comes straight from your answer in B. 375,411. We've done the depreciation. All of these things we've discussed. Obviously, your answer here would differ because of that 12,000. Times that by 28%, and that gives you your tax expense. In terms of my tax rate recon, the amount over here, where is that pen? This one. 307,135, which will change, is South African normal tax, so you put it in there. Foreign income is what you paid, 13,200. And your movement in temporary difference, this is now at 28%. Exactly what you calculated is a negative 200,340. Right. That's my, okay, so I don't think they actually asked me for the income tax note. They didn't. They only asked me for the tax rate recon. But I just wanted to show you that it needs to balance. Okay? Right, so the tax rate recon, the profit again comes straight from my profit before tax calculated in B. I times that by 28% to get to my expected profit. This is what they expect to see on my profit before and loss statement. Then I show them all the reconciling items which I've already discussed, and I get to my income tax expense. Effective tax rate would be my tax calculated over here divided by my 375,411 profit. So I'm saying that I pay tax at 28%. What is my effective tax rate? Okay, make sense? Okay. E and F was that disclosure which we've already done. That concludes question 1. Any